And just like that, we've got higher interest rates. Okay, what does this mean for you? What are the implications? I've got that and more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. All right, so 15 months after the Fed said, we want inflation, bring it on. We want to create inflation. We have an inflation problem. Just a couple months ago, the Fed was still saying, the Fed was still denying, nah, we don't. And now they're in all-out attack. There's all sorts of questions about what will the Fed do to try to manage inflation. In fact, last week, Fed Chairman Jerome Powell came out and said, we will raise rates more or longer to fight inflation if necessary. Well, that's the good news that we needed, right? So what are the implications here, and what's this all mean for you? So the first thing is the stock market, okay? What are the implications with the stock market? Now, there was a while ago, the Fed says, we're not gonna be raising rates until 2023 at the earliest, okay? Now take a look at this article. Goldman Sachs is projecting 4 interest rate increases during 2022. On average, I saw a different stat that on average, the market or various economists are expecting 3.7. I think pretty clearly we're gonna get somewhere close to 4. Very possible. We could see the first interest rate hike by the Federal Reserve here in March. I mean, that is a year or more sooner than when the Fed originally said. And to me, this starts to question the confidence that citizens should have in the Fed, in my opinion. I mean, this has been dangerous what they've been doing. So we'll see if they can navigate through it. Some of the smartest people on the planet, we'll see. Hopefully they can. But it's likely they will be raising interest rates several times this year, and that's an implication for the market. Can the market stomach that much? And there's all sorts of economists out there that are saying, well, listen, if the Fed funds rate gets up to 1.75 or 2, I think that could break the market. I don't think the market and the economy can sustain that rising that quickly. We'll just have to see, right? We will just have to see. Ultimately, I think 2 things for implications for the market with these interest rate increases. Number one, I think it could create a lot more volatility. We're already seeing that. As interest rates are going up, tech stocks or high beta stocks, sorry for the jargon, I mean, are already taking a hit based on speculation, based on just the economics of it, just the math of it, okay? The NASDAQ and tech stocks, growth stocks are struggling every time we see interest rates going up. So that's one implication. The second, though, is if you look at long-term bonds are still saying the economy can't get overheated for long, okay? Those interest rates are not going up at all. Those are still very, very low. Well, what happens if the open market is pushing 2-year rates up and 5-year rates up and 10-year rates up, and the Federal Reserve starts raising, the Fed funds rate, the overnight rate, right? But long-term interest rates stay here. If those interest rates start going up and long-term rates stay here, we get a flat yield curve. We might even get an inverted yield curve, which has preceded every recession out there. Even the one where we shut the economy down, I mean, that's sort of a gimme. But of course we are going to see a recession, but we actually had an inverted yield curve a couple months before that. And so it's not a perfect indicator, but it's as perfect as we've got. And the more interest rates are going up in the short term, if long-term interest rates don't believe we're going to have this huge, robust economy for a long term and those interest rates stay low, we're going to get a flat and inverted yield curve. That spells trouble for the stock market. Second implication, what's this mean for your savings account? Nothing. Nothing yet. Don't be confused if you're seeing headlines about, mortgage rates are up or interest rates are up. Interest rates have been rising. Fed's going to raise interest rates. What you're getting on your savings account is still nothing, okay? The Fed would need to raise, your interest rate that you receive on your money market account, your money market fund, your savings account, something like that, is going to be more closely tied to what the Fed does with interest rates. Those are going to be more focused on short-term rates. And as the Fed starts to raise interest rates in the short term, there's going to be a lag 3, 6, maybe 9 months, but that will start raising interest rates in your mortgage, or excuse me, your savings account. We're a long way away. Before the pandemic, I think my savings account got up to 2%, something like that. We're a long way away from that. I would love to see, I'm in a high interest savings account. You should be as well, your money market. It's 0.5, right? Some of them are 0.4. It's going to be a while until we see that move up, and it's going to be even longer, maybe impossible, before we see that move up meaningfully. So in the short term, this means nothing for the savings account interest. Savers, you're still getting punished. Now here's the bigger one. Take a look at this article here. The bigger implication, yes, stock market, that's a concern, but also housing market. Mortgage rates now, on average New Year rates are now over 3.6%. You might say, that is cheap. I know it is. But a year ago, average was 2.75, and now 3.6. That's a 1% increase. Mathematicians would say that's a 50% increase. Okay, it's a 1% increase on a 1% higher interest rate than a year ago. Guys, that means that's dollars and cents. That means the cost of this really expensive house is even more expensive now. And if that's happening before the Fed even starts raising rates, I've got some concerns about the housing market. And the housing market is so vital to the economy because of how much consumer spending is driven with it, okay? As you buy a house, when you sell your house, okay, let me say this. I'll do it this way. When you buy a house, right, you're likely going to also buy paint. You're going to buy a rug. You're going to buy a lamp. You're going to buy some furniture. There's usually a 6-month fog in your finances because you've already made this commitment to buy this house. You then need to buy the lawnmower. You then need to buy some stuff to go along with it and make that house your own. Usually that's at least 6 months, if not a little bit longer. So there's a lot of additional spending. And that's you buying the house. Well, you had to sell your own house, so the person that's buying yours, they're doing all that same stuff as well. So it's so extremely important for the overall economy, and we already have dangerously, high valuations for houses because of all the money printing and everything. The cost of houses has just gone up, straight up, okay? Very, very high, very, very quickly. If we increase interest rates, mortgage rates, if those continue to go higher, that could put a serious damper on the housing market. And I'm going to tell you, it just feels like if we see a hard landing with the housing market, that's going to be trouble for the overall economy. If things don't smooth out and the price increase for houses, if that's not a gradual, continued increase, if it plateaus flat or starts going back down, that's going to be bad news for the economy. And interest rates going up, the mortgage rates going up, even before the Fed starts raising interest rates, that's a concern of me. So what does all this mean for you? Make sure you're diversified with your stocks, not taking too much risk. I would still argue that you need a diversified buy and hold strategy along with a momentum strategy, something that can adapt in case the Fed does raise interest rates too quickly trying to fight inflation and end up hurting the economy, hurting the stock market. That's very possible. Second, just expect you're going to get low interest rates on your savings account. Still use a high yield money market, okay? That's where your emergency fund should be. However, don't go out and try and chase yield. That will mean you're taking more risk than you should at a time you probably shouldn't, okay? And then lastly, make sure all your loan rates are fixed. And if you're looking at making a housing change, work that budget. Interest rates are still low, but they're higher than where they were. Make sure you're doing that math so you don't get overextended. Work with your CFP on all of those things, right? That's why we recommend comprehensive financial planning. All of these things are interrelated. Work with your CFP on that. If you don't have a CFP on your team that can help you, contact one on my team. You can find us online, Korhorn.com. That's Korhorn with a K, wisemoneyshow.com. You can find us there as well, or send us an email, info@korhorn.com. All right, there you have it. Go out and take your next wise step in your financial life.